Hey everybody, Chuck Barone. It's Wednesday, May the 24th, 2023. Hump day in the middle of a week. Another week of crazy in the United States, in our financial markets in the world, man. Wow. Before we get rocking and rolling here, let me just welcome everybody to the show. As always, thank you guys for your support. We appreciate you guys, we do. All right, so let's look at these markets today, guys. As we know, and we've been seeing in the newspapers and everywhere we look, it's debt ceiling crisis. Oh my God. They're making progress. They're not making progress. It looks like they're going to give some concessions. Oh, they're not going to give some concessions. There's not enough urgency. Guys, today's the 24th. We got a week left in May. We got a week to dial this in. These yo-yos, they're going to wait till the very last second just to make it even worse, right? But I'm telling you, I got to think that this debt ceiling is, it's just not going to, they're not going to let the United States default. So the market freaking out about really not much here today. Although I guess, the rhetoric they're using, market now actually factoring in a 25% chance of default. Can you believe this? Anyway, so the market's today reacting terribly, down again. The Dow down 255 points, 32,799 on the index. The S&P broader market down 30 points, 4,115 on that index. The NASDAQ down 76, 12,484. So really, market's down, but not by very much. Just a head fake, and this is just all made up fluff, man. You don't need to be trading on this, okay? Let's get to serious stuff. Anyway, the bond market today, yields rising again, bonds selling off. I was reading today an interesting article. They were saying that traders are selling short-term treasuries. Remember I was telling you in the show the other day, 1-month treasuries spiking up to 5.88%. They said the traders now, because of this default or debt ceiling default talks, they're dumping super short-term treasuries and buying instead corporate debt. Go figure. They're buying AAA graded corporate debt, Microsoft companies that, there's no chance they're going to miss a payment. So I thought that was interesting. So the bond market today, though, as usual, looking just horrendously crappy. The 10-year up 2 basis points. The bond down. So the yield up 2 basis points, 3.72% on a 10-year. The 2-year jumps 8 basis points, 4.37%. Not much, guys. Just, this bond market whipsawing around, can't make up its mind. There's no real direction, right? Anyway, dollar today, up again small, but still climbing, man. 103.89 on the index, up nicely, strong dollar. Putting pressure on gold and silver, sadly, with gold dropping today, $15.60. $1,960.10 for an ounce of gold. Silver drops 38 cents today, $23.04 for an ounce of silver. Still pretty good numbers. Tough market right now for gold and silver with the dollar rallying like it is. I know there's really not much reason for the dollar to rally, especially with, this is like completely contrary to this default scenario, right? You would think if the United States was going to default on its debt, people would be fleeing dollars. They're not. Okay, so ask yourself the question the way I always tell you to ask it. Is a default by the United States government good for the billionaire class? Is it good for corporate America? We all know the answer to that is no. That's why it's not going to happen. Anyway, so gold and silver down, commodities under pressure. Oil, though, up today, up 96 cents a barrel, $73.87 for a barrel of West Texas Intermediate. Still right there in that trough we've been telling you guys, between 70 and 75 per barrel. That's where it tends to kind of be comfortable in that trading range. And there it sits still. Bitcoin today down pretty dramatically, down $967, was down deeper than that earlier in the day. 26,239 for Bitcoin. This is another one that's kind of been in this trough. Not much happening really in any of these markets. Just kind of drifting up and down, choppy, but in a trough and just staying there. So these markets, you know, people aren't really, unless you're trading actively, you're kind of just sitting static. And I'm not suggesting you go and start trading, because this is an impossible market to trade in. But anyway, here we sit with these markets. So if you're looking at your 401k, it's probably not looking much different than it did a month ago, or a couple months ago even. But let's talk about news today. Okay, so now some of the minutes from the Fed meeting are starting to trickle out. And I guess the big news in these minutes is there's some division now in the Fed as far as what the future for rate hikes is. You got some Fed officials very hawkish, feeling like, you know, with CPI at 5, that they are nowhere near where they need to be. They need to continue to hike rates aggressively till they get the inflation number where they want it to be. There's the majority, I think, though, still in the dovish position, which kind of where Powell seems to be right now, talking about, let's see what the effect of the increases we've already, you know, put in place have on this economy. We know it takes a while for the effects of those rate increases to be fully absorbed into the economy. So really a lot of the increases that the Fed did last year are still not fully absorbed into this economy. Interesting that, you know, the Fed nowhere near its 2% number. Do you think, now I'm starting to feel like maybe the Fed's gonna, they can't really do it politically correctly right now. But I think as they get closer to 2%, however long that takes, they're going to start, what they call it, moving the goalposts, and this 2% target might become a little bit more flexible. I think that that's something that could really happen. The 2% really never was anything official till they had pretty much announced it in 2012. This 2% target is now something that they put in place arbitrarily. It's certainly not a law, right? It's just a target. Interesting that, you know, they've had their way for the most part since 2012, where we had very, very, very low interest rates, very, very low inflation. Actually, we're looking at a deflationary situation with real estate crashing. So it's interesting. Now, let's see what kind of stones the Fed's got. Let's see, really, because they're going to be faced with their Hobson's choice sooner or later. I want to see how they react to it. Also interesting was, I see Ben Bernanke, old helicopter Ben, throw the money out of the helicopters. This is a guy who was a massive part of the inflation, of this whole modern banking crap of what they're doing at the Federal Reserve now. Of course, he's talking about how much more work the Fed needs to do to get inflation down. Now, this is what they call in upper society bad form. Typically, you don't go out and talk much, especially about what your successor's doing. Ex-presidents typically don't talk much about what their successors are doing. It goes all the way trickling down. The higher the job, of course, the less they do of it. Interesting to see Bernanke feeling like he needs to get some time in the press. I don't really know how much influence he has at the Fed right now, but if he gets involved, well, who knows where we go from there. Okay, moving on. I was reading an article today that kind of made me have a little bit of a sad today. You know, I've been harping on the situation most consumers in this country are in right now. Dead-ass broke. The vast majority of them not being able to handle even a simple emergency without borrowing money. Prospects unhappy, prices going up on all the necessaries, their paychecks not really going up. If they are, they're not really noticing it much. Tapped out, bummed out. Well, now I was reading today, consumers even skipping just basic medical stuff now. because they can't afford it. 28% of the people they polled said they skipped some type of medical work in the last 12 months. Anything from elective surgeries to the simplest, just my yearly checkups or get some blood work done or whatever it is. People can't even afford now to go to the doctor. 28% of the people polled said they skipped medical care. We know consumers are broke. When you can't afford to go to the doctor, that's really broke, right? Interesting, on the other side of the coin today, Toll Brothers, big building company, real estate construction company, one of the actually high line companies, they come out today, had a great earnings report, making money, talking about the market picking up as home buyers are wading back into the market. They also were talking about the shortage of houses for sale and how that this housing shortage will benefit the industry. By benefiting the industry, they mean benefiting their own bottom line, right? Now, right now, there's not really a shortage of houses. There's just a shortage of houses for sale. People who have real estate that would be thinking of selling right now are kind of stuck prisoners in the house they have because of what's happened with interest rates. People that bought houses a few years ago and got these 2%, 3% interest rates, even people that got rates in the 4s, that's pretty good compared to the 6.5s we're looking at right now. So they're very reluctant to sell, even if they have pretty big gains in their equity, because buying a new house would entail taking on a new loan at a new rate, and the payments, even on smaller loans, are dramatically higher. So they see no reason why on earth they should sell their house. As a result, the supply of houses on the market, existing housing, is just cratering out with, I think they said they have about a 6-week supply, which in a normal market would be 6 to 12 month supply. So it's pretty dramatic, which is propping prices up and also driving buyers to builders, which is why Toll Brothers is so happy about the benefiting the industry of the shortage, right? Experts I was reading, it's crazy, they were saying that affordability right now is the worst it's been in 100 years. They said that right now real estate, the housing market has entered an ice age. That's the quote they used, ice age, crazy. So real estate really having it tough. The buyers that are in the market typically are someone who's moving from someplace or for some reason or other came into a windfall in real estate and reinvesting that money. Very, very little new money coming into real estate right now. First-time buyers are pretty much frozen out. They're in there kicking the tires and they want to buy. But when they see these prices, they see these payments, they change their mind pretty quick. Anyway, that's it for the day, guys. Tomorrow we'll start it up. It's going to be really crazy finish to this week. We'll have a lot of data coming tomorrow. Big data coming on Friday. Of course, we'll get more inflation news. We'll get more news. Tomorrow we'll get unemployment numbers. We'll get the CPI. We'll get the GDP numbers. We'll get all kind of fun information finished this week. We'll get the consumer expenditure, CPE, consumer purchasing expenditure, whatever deal the Fed follows. We're going to get all of this data coming in over the next couple of days. We'll read through that data, get an idea of where that's going to head these markets to. Important. The market seems to always want to finish the week with a flourish, start the week with a yawn. So we'll see where we go tomorrow. We'll be here to bring you guys the news you need. Until then, guys, take care.